Welcome to vTalkInsight, Allocator's Lens Daily for January 5th, 2026. Markets are starting the year with a powerful mix of AI-driven equity optimism, expectations for easier central bank policy, and unusually low volatility, even as deficits, elections, and geopolitics loom large. That tension between supportive fundamentals and latent macro risk is shaping decisions across equities, rates, credit, currencies, and commodities. So let us begin with equities, where the AI narrative remains front and center. In equities, the dominant story remains AI-fueled growth set against a clearly late-cycle backdrop. Expectations for the S&P 500 are robust, with earnings projected to rise around 10 to 12% this year on mid-single-digit revenue growth and still healthy margins. And all 11 sectors are expected to post earnings gains, something markets have not seen for several years. Underpinning that outlook is strong business investment in AI infrastructure, where big technology firms are expected to spend roughly $600 billion in capital expenditure, and where leaders like NVIDIA, Microsoft, and other chip and cloud players are seen as several years ahead of many global competitors. At the same time, there are clear signs of broadening beyond the original AI champions. Large-cap tech stocks that lagged in the fourth quarter now come into the year with somewhat lower valuations despite strong earnings, while sectors such as financials, industrials, communication services, and select healthcare names are highlighted for double-digit earnings and margin growth. Commentary also points to lagging areas like certain social media platforms, railroads, automation firms, and consumer and animal health names as potential beneficiaries if earnings growth outside the largest technology stocks accelerates, and if the equity rally continues to widen beyond the so-called Magnificent Seven. Geographically and thematically, leadership is no longer purely a United States megacap story. Investors have been diversifying toward non-dollar assets and international markets, helped by strong runs in Asian technology hardware, including memory and AI chip producers, and by anticipation of a wave of Chinese AI-related initial public offerings that reflect Beijing's push for tech self-sufficiency. Within themes, the market continues to reward AI beneficiaries such as vertically integrated platforms with proprietary data and in-house chips, as well as smaller AI software firms that can scale revenues with relatively low headcount, even as more cyclical consumer and auto-related names struggle with affordability issues and a cooling electric vehicle cycle. The risk side of the equity ledger is equally important for allocators. Several signals point to stretched optimism beneath the still subdued retail mood. Wall Street strategists are unusually unanimous in forecasting S&P gains with a very narrow range of targets. Corporate bond and high-yield spreads are historically tight, and the main equity volatility index sits in the mid-teens. At the single stock level, valuation questions around names like Apple, which trades on a rich earnings multiple with only modest expectations for AI-driven iPhone upgrades, highlight the tension between growth narratives and already embedded pricing. Macro and policy add further uncertainty, from midterm elections and the historical pattern of weaker equity performance in those years, to the possibility of Federal Reserve leadership changes that have, in past cycles, coincided with market stress. On top of that, there is the risk that long-term Treasury yields spike toward 5% if inflation or fiscal worries reemerge, or that a more meaningful slowdown in the labor market finally hits consumer spending, which remains the backbone of earnings expectations. For equities, the near-term message stays supportive, especially for AI-linked and earnings-resilient sectors. But the balance of risks later in the year looks increasingly sensitive to rates, politics, and the durability of the consumer. Turning to rates, the central narrative is of gentle policy easing against a backdrop of stubborn fiscal and inflation questions. The 10-year Treasury yield sits a little above 4% and has been fairly stable, and several views suggest it may trade in a range around 3.75% to 4.25% as long as there are no major shocks. Markets are generally pricing 2 to 3 Federal Reserve cuts this year, while some see the longer-run neutral rate drifting back toward roughly 2%. implying that today's policy stance is still restrictive and that further easing would be consistent with both softer inflation data and a weakening labor market. Yet beneath that relatively benign surface, the structure of the curve is shifting in ways that matter for every asset class. The yield curve is expected to keep steepening as front-end rates fall with Fed cuts, while long-term yields stay elevated due to persistent inflation close to 3%, large and ongoing budget deficits, and heavy treasury and corporate issuance, including from technology firms funding AI buildouts. Concerns around rising term premia, questions over the Federal Reserve's independence, and political pressure for easier money are all cited as reasons why long-end bonds may deliver only modest price gains, even if policy rates decline. Volatility in rates markets is another fault line to watch. Implied volatility across bonds, currencies, and equities is currently low, but several observers warn this may not last as midterm elections approach. Leadership at the central bank potentially changes, and fiscal debates remain contentious. There is also a view that yields could rise in the first half of the year, depressing coupon returns before falling later as growth and inflation slow, which would favor more tactical duration management rather than a one-way bet on falling yields. For multi-asset portfolios, the combination of a steepening curve, higher risk premia, and event risk means interest rate moves will remain a key transmission channel into equity valuations, credit spreads, housing, and emerging markets. In credit, the picture is one of strong recent performance, but increasingly asymmetric risk-reward. Investment grade and especially high-yield spreads sit near post-financial crisis lows, helped by solid corporate earnings, resilient bank lending, and heavy demand from investors still hungry for yield. U.S. fixed income returns are expected to be positive this year, but with a steepening curve, lingering inflation, and tight valuations, the upside in spread products may be more limited than in prior years. Several fault lines could challenge that benign view. High levels of government and corporate issuance, including borrowing to fund AI infrastructure, could push yields higher if investors demand more compensation, while any negative earnings surprises, particularly in highly levered or rate-sensitive sectors, could prompt a widening in risk spreads from very compressed starting points. Household balance sheets also bear watching, with rising living costs and increased reliance on credit signaling stress at the margin, and the expiration of enhanced health insurance tax credits projected to leave millions without coverage, potentially weighing on consumption and parts of the healthcare complex. Against that, emerging market bonds, especially in Latin America, stand out more positively, where disinflation, attractive real yields, and expectations of a weaker dollar are already drawing global capital flows away from richer U.S. credit markets. Foreign exchange markets are quietly repricing the role of the U.S. dollar in portfolios. Despite last year's depreciation, models suggest the dollar remains significantly overvalued on a purchasing power basis, and several forecasts point to a broad, multi-year decline, including the potential for another sizable drop this year as Fed cuts and slower U.S. growth take hold. At the same time, the dollar's traditional safe haven status is being questioned after it failed to offer much protection in recent equity drawdowns, encouraging investors to look to gold, other reserve assets, and select currencies as alternative shock absorbers. The likely path of dollar weakness looks uneven across regions. Pressure is expected to show up more clearly against Asia-Pacific currencies than against Europe, where stagflation risks cap enthusiasm for the euro, while emerging market currencies, such as Mexico and Poland, are highlighted for attractive interest rate carry and improving inflation dynamics. This backdrop supports the broader trend of shifting allocations toward emerging market fixed income and equities, particularly in Asia and Latin America, as investors seek higher yields and undervalued assets outside the United States. Crypto assets are increasingly part of the FX and liquidity conversation as well. In the United States, new market structure legislation and clear stablecoin rules are paving the way for broader institutional use, with large banks exploring their own stablecoin offerings and exchange-traded crypto products seeing strong inflows despite limited marketing. Ethereum is singled out as a key beneficiary of this shift, thanks to its track record of reliability, dominance in stablecoin issuance, and growing role in asset tokenization, while anticipated staked Ether products could further integrate yield-bearing crypto into traditional portfolios. Bitcoin's technical picture looks weaker in the near term, with prices below longer-term moving averages and risk of retesting prior lows, but the broader ecosystem appears more robust after recent deleveraging, with no obvious signs of hidden insolvencies. For allocators, that mix of regulatory progress, institutional build-out, and still volatile pricing means digital assets are moving from the fringe to a more mainstream, though still high-risk, macro instrument. Commodities round out the late-cycle feel, with precious and industrial metals center stage. Gold and silver have just delivered their strongest annual gains in decades, helped by central bank buying, geopolitical tension, and de-dollarization flows, and they are expected to remain volatile but biased higher as investors seek hedges against both inflation and financial repression. Some major houses even flag upside scenarios for gold that sit near $5,000 an ounce, underscoring how powerful the structural demand for safe havens has become when faith in fiat currencies and policy frameworks is being tested. Industrial metals tell a complementary story about real economy investment and supply constraints. Aluminum prices have surged above $3,000 per ton for the first time in more than 3 years, supported by tight supply in China and Europe and long-term demand from construction, autos, and renewable energy. Copper and silver are also expected to benefit from the build-out of AI data centers, the green energy transition, and United States infrastructure programs, with some companies and countries reportedly moving inventories into the U.S. ahead of potential new tariffs. This combination of structural demand and supply bottlenecks suggests that metals volatility is likely to remain a defining feature of the commodity complex. Energy markets are more finely balanced, but carry significant geopolitical optionality. United States sanctions on Chinese-linked tankers and efforts to restrict Venezuelan oil exports highlight how quickly policy can shift, and there is a strong probability of political change in Venezuela that could reshape regional supply dynamics and great power competition in Latin America. At the same time, Europe faces rising stagflation risks, making inflation hedging through commodities more pressing there than in the U.S., while Washington's multi-year push to rebuild domestic manufacturing and energy infrastructure points to sustain demand for steel, copper, aluminum, and related inputs. For multi-asset investors, commodities are increasingly serving both as cyclical plays on infrastructure and AI energy demand, and as strategic hedges against currency debasement and geopolitical shocks. Stepping back across assets, the early year picture is of an equity market still powered by AI, spending, and broadening earnings growth, a rates market that expects gentle Fed cuts but wrestles with deficits and term premia, and credit spreads that leave little room for disappointment. At the same time, a structurally weaker dollar and clearer crypto regulation are nudging capital toward emerging markets and digital assets, while gold, silver, and industrial metals express both the inflation hedge and growth infrastructure stories. With implied volatility low, midterm elections approaching, and questions around central bank leadership and fiscal discipline unresolved, allocators may find that cross-asset signals matter more than any single headline. Watching how long-term yields trade, how earnings outside the largest tech names evolve, and how the dollar and metals behave around geopolitical events will be key to understanding whether today's supportive backdrop endures or begins to fracture. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.